If I had a dollar for every time someone told me they took Social Security at age 62 because they wanted to get their money before the government spent it all, I'd be a wealthy man. And look, I get it. Social Security is your money. You've paid into it your entire working life, and there's absolutely nothing wrong with claiming it early if that's the right decision for your situation. But here's the thing, for a lot of people, it's not the right decision. And they don't realize that until it's too late to change it. Because once you claim Social Security, that's it. The clock doesn't reset. So today, we're going to break down everything you need to know about Social Security and the claiming decision, the math, the strategy, the tax implications, and how it connects to your broader picture and your broader retirement income plan. I'm Chris Brumlow. I'm a partner at the BAB Group, and I'm your host of On Course Financial. So let's chart the course. Let's start with the fundamentals. Social Security has three primary claiming windows that most people should know about. The earliest you can claim is age 60. Makes sense because the credits stop accumulating, and that's age 70. And somewhere in between is your full retirement age, which the Social Security Administration calls your FRA. Now, depending on when you were born, your FRA is either 66 or 67 or somewhere in between. Now, here's what those ages mean in terms of your actual benefit. If you claim at 62, the earliest possible age, your benefit is permanently reduced. We're talking roughly 25 to 30% reduction compared to what you would get at your full retirement age. That's not a temporary penalty. That reduction is locked in for the rest of your life. If you claim at your full retirement age, let's say 67 for simplicity, you get 100% of your earned benefit. That's your baseline. If you delay past your FRA, your benefit grows by 8% per year for every year you wait, up to age 70. So if your FRA benefit is $2,500 a month, waiting to 70 gets you to roughly $3,100. That's a 24% increase just for waiting 3 more years. Now, I want to show you a simple table. I'll link it in the show notes below that illustrates how this looks in real numbers, break even math. Here's a concept that most people often overlook, the break even age. If you claim Social Security early, you get more checks, but smaller ones. If you delay, you get fewer checks, but bigger ones. The question is at what age does the cumulative lifetime benefits cross over? If you claim at 62 versus 70, the break even age is somewhere around 78 to 80, depending on the number. What this means is if you live past 80, you'll collect more lifetime Social Security income by waiting. If you pass away before then, early claiming was mathematically better. Now, here's where most people make a mistake. They think about break even in isolation. They think, well, I don't know how long I'll live. I'll just live. So I should take it early. And for some people, that reasoning is valid. If you have significant health concerns or you desperately need the income, those are real considerations. But the mistake is just treating this as purely a bet on your lifespan because it's not just about longevity. It's about your complete retirement income goal. And that's where the conversation gets much more interesting. Here's the tax angle that nobody talks about. Here's the part of the conversation that most financial advisors don't spend enough time on. Social Security is not automatically tax free in retirement. And depending on your total income, up to 85% of your Social Security benefit can become taxable. How does that work? The IRS uses something called combined income, which is your adjusted gross income plus your non taxable interest plus one half of your Social Security benefit. And that combined number, if it exceeds $34,000 for a single filer or $44,000 for a married couple, up to 85% of your Social Security is taxable. So here's the scenario that plays out all the time. Someone retires and starts taking Social Security early. They also have a 401k that they're drawing from, and suddenly their Social Security check, the check that they thought was their safety net, is getting partially taxed on top of everything else. Now, contrast that with a different strategy. You delay Social Security until age 70. During the gap years from retirement to age 70, you live on a combination of taxable accounts and Roth distributions. Your income during that window stays low, which creates a window to do more Roth conversions at a favorable tax rate. Then at age 70, you turn on a larger, more reliable Social Security check because your other income is structured more efficiently. You actually might get to keep more of it. And that's the integration play. Social Security doesn't exist in the vacuum. It connects directly to your tax bracket, your Medicare premiums, and your Roth conversion strategy. At the BAB Group, we look at all this together, holistically, not as separate decisions. Now, I want to be fair here because claiming early isn't always wrong. There are real situations where claiming at 62 or before your FRA is the right call. If you have a serious health condition or your life expectancy is genuinely shorter than average, the break-even math shifts significantly in the favor of claiming early. There's no point in waiting for a bigger benefit if you won't be around to collect it. If you've lost your job, if you're not eligible for disability, or if you genuinely cannot bridge that income gap in some other way, sometimes Social Security is the bridge. If your spouse will receive a survivor benefit based on your record, the calculus gets more complicated. In some spousal benefit situations, having one spouse claim early and one delay can be a very strategic combination. The point is, the right answer depends on your complete picture, your health, your income needs, your other assets, your spouse's situation, and your tax environment. That's why this isn't a decision to be made based on a YouTube comment or a buddy at the golf course. It's a decision to make with someone who can run your specific numbers. Now, one more layer I want to add into that is the Medicare connection. And this one catches people off guard. If you claim Social Security before you enrolled in Medicare, there are some timing issues to manage. But more importantly, once you're on Medicare, your Part B and Part D premiums are determined by your income the 2 years prior. This is called IRMA, IRMAA, the income related monthly adjustment amount. And if your income is above certain thresholds, you can pay significantly more for Medicare. We're talking about hundreds of dollars more per month per person. The connection to Social Security, your claiming strategy affects your taxable income, which affects your IRMA calculation, which affects your Medicare cost. It's all connected. And a well-designed retirement income plan takes all of these into account. This is one of the reasons we strongly encourage people who are within 5 to 10 years of retirement to sit down with us and run the scenarios before making this decision, because you can't unring the bell. So, where does all this leave you? A few things I want you to take away from today's episode. First, know your full retirement age. Go to ssa.gov and pull your Social Security statement. Look at what your projected benefit is at age 62, at your full retirement age, your FRA, and at age 70. Those numbers are your starting point. Secondly, don't make the claiming decision in isolation. Think about it in the context of your other income sources, your tax situation, and your spouse's situation if you're married. Third, if you haven't had a comprehensive retirement income planning conversation that includes Social Security as one piece of a coordinated strategy, that's exactly what we do at the BAB Group. We're holistic. We're not just investment managers. We're tax strategists. We're retirement income architects, and we can help you see the full picture. You can reach us at babcfo.com and schedule a complimentary consultation. And let's look at those specific numbers together. I'm Chris Brumlow, and this has been On Course Financial, charting your path to a tax-smart retirement. Thank you for spending this time with me today, and I'll see you on the next episode.